Greetings, market rebels. Welcome to this week's macro measure. It is actually Friday, August 18th, 2023, about 20 to 3 p.m. here on the East Coast. I'm Wayne, and my partner Ryan, who will be working on the weekend outlook, will unfortunately, soon be on his way back from Venice to the United States. And so he'll get that taken care of, though, at some point this weekend. But I'm recording this a little bit early because I've got some friends and family coming to town. And so I may not have a great opportunity if I wait too long. So trying to sneak this and sector situation in today, and then we'll hopefully be clear for the weekend. And I can always do another quick update video if something requires that, or if some situations develop. Anyway, here's our trusty disclaimer. And here's our trusty intellectual property rights notice. And then finally, I'm going to go with, I'll skip over this and come back. I'm just going to flash. This is last week's stream. If you want to take a brief snapshot, quick snapshot of that. And then I'll come back to this week's stream and I'll leave that up there. And then I'll do my old repositioning work like I typically do. And then we'll get into it. But updated things a little bit. There's a lot of stuff. We did see a lot of the things that we thought might be on the way come to fruition. And so we probably should note that we've been, I guess, tracking the market. I think fortunately our tracking's been pretty good overall. And it looks like things conformed again. So we have to be grateful for that we at least had an idea, right, that this was on the way. It was starting to shape up. So with that, I'm going to do a quick pause, and then I will reposition things and we'll get going. I'll bring this off screen. I'll bring this on screen. And then we'll get rolling on the charts and the browsers. The browser tabs are going to be very brief today. Let's get the right chart up. So the right chart is right there. So this is the screen where it should be looking at the QQQ. And so I'll go through things methodically, but I think what I'm going to do is skip to the tabs, and then we'll come back really to the charts and just some of the rest of our discussion, just to do a very, very brief and quick tabs check. And that should start right about there. I'm going to start here with them. And so we were saying, really, it's been about a month ago, roughly speaking, that we thought that, okay, this was up there in terms of the percent of stocks above the 20-day. Could you see a correction from there? Yes. Could it go a little bit higher? Yes. But you were definitely in the ballpark, and you could see that really did happen, right? So at this point, not that there isn't more downside, maybe there is, but this has been a legitimate sort of technically damaged situation in terms of the corrective activity we've seen so far. And the thing is, I think the Qs and spiders, the Qs are down a little bit more from high to low, but bottom line is, like, I think spiders dropped about 5.5% and Qs dropped over 6, maybe 7. I'd have to check it. But anyway, the point is that, right, we did see some pretty decent damage done to the market, and we thought it was time for that for a lot of reasons. We had a lot of good, I think, support to think this was potentially on the way. And it did come back down to a significant level on the percentage of stocks above the 50. And then finally, we'll check the 200. But all of these have really been worse for the wear, especially, right, the percent above the 20, which was probably rising in many cases and much closer to the action. And that's why the 20 was hit us especially hard compared to the others. So there was a lot, probably more room for on many stocks before you could get anywhere near the 50 or 200, given the strong ascent we saw. I mean, the Qs, as I've noted many times, the Qs did jam about 53% by my calculation from the OC low to the recent high that we saw. So no small rally. It was definitely a very powerful one that was had a lot of opportunity, sprinkled over the course of it. It was honestly, I think, an excellent trading market for the most part. And just wanted to flash this because we only have a few tabs to cover, that we have this happening right in terms of the end of the year. So this would be, right, the final Fed meeting for 2023. And you could see that the market's expectations are, when you add these three together, right, you're just a little bit over 91%. So right now you'd have to say the way the markets are looking at it, there's a 91% chance we'll be where we are in terms of the current target rate, or even higher. There's a 91% chance of that. So this to me is again worth reiterating, especially if you're new. My premise for one of the main underpinnings of, I guess, of my way of looking at it, and as to why I just don't believe the equity bulls, I don't believe that was the start of a bull market, and I hope to be wrong, is because I feel as though rates are going to be up far longer, far higher than bulls had it, and they were kind of peddling this almost cut rate sooner stuff late last winter into the spring. And so rates have not only gone up since then, but they've gone up and stayed up much longer than the spin would have had it at the time. And I think that's a big problem. Ultimately, I still believe that interest rates matter to consumer behavior and business behavior. So we'll see if I end up sticking to my old timer guns and if that paid off. But I think it's very hard for such a debt dependent economy in so many ways to continue to advance strongly, with growth being really nothing special, overstated, and higher costs, people being squeezed more and more, and now the main driver, which has often been the case in the modern era, your housing market is under, I think, pressure as a result of these higher rates. But anyway, and very, very high home prices as well. But if you wonder, well, did we see enough, right? If you're saying, well, I can go along with the pullback, but I'm not so sure I can believe that there's a lot more to come. Well, you've got maybe at least some of what you need here in terms of this imperfect measure that CNN publishes. It's come off a lot, and it's in fear territory, not extreme, but it is in fear territory. We did note that extreme greed was persistent, right? So we thought that after a while, especially with the seasonality from the third year of the presidential cycle, August and September particularly being not so wonderful, they're not great months in general, that we were due for this. And there was a lot of there was a blackout in terms of the calendar and justification to be able to continue to move stocks up in the manner at which they were doing so prior to, right, the July EPS season sort of conclusion. Anyway, this is also good from a contrarian perspective, where we were a little surprised just a few weeks ago how sharply the bullish sentiment had bounced back, according to AAII, according to that survey. And you could see the historical averages are down here, and you could see that that's the highest high that was registered, and you weren't all that far away only 2 weeks ago. And so that really struck us at the time, and it was good. I think it was good. It made what we just saw possible in terms of getting this pullback. And now that's corrected dramatically. So it's even a little bit lower than the historical average. So again, I think you have seen corrective activity, right? You've seen enough to say, well, yeah, something happened. And you can't dismiss that, saying, oh, there hasn't been any correction. So now that helps out, right? If you're a bull, it actually helps you, I think, because now things aren't completely without rest, right? You've gotten some rest or pullback in here, a little bit of natural decay of the trend, and now it's your opportunity. And I think I don't want to try to create drama where maybe there won't be any, but as I've said many times, we should be looking at the Qs chart at this point. August is not that wonderful of a trading month typically, and a lot of Wall Street does go on vacation during the second half of it. And it is the last hurrah for summer, and families tend to not be focused on it. A lot of people are not so focused on the market. And so you have all that at work. Some of these Augusts, in my experience, have been super listless, but there have been the times where they haven't. And that's usually because there's some sort of a financial crisis or credit event or something like that brewing. So I think that's worth noting, that if bulls do not step in soon and start supporting this action in a bigger way, which they could, right, anytime. But if they don't do that, then you're in a situation where they're really risking a really, really ugly monthly candle that could really sort of overhang the market, if not exacerbate the selling for a longer time period or longer duration. And so with that being the case, they may want to, if you're a bull, you probably honestly want to see this market recover decently over the next couple of weeks to at least hopefully forestall more corrective action. But you're seeing, right, what we expected in the write-up. We'll talk a little bit about that right now. This week coming in, we thought expect volatile movement, expect a little bit of everything. We found it difficult to pound the table at that moment in time because it wasn't as easy as the prior week where we thought things should slide. And we wondered if we were short-term oversold and that they might put a little bear trap together and then try to rally things. And the funny thing was that scenario that we talked about happened, believe it or not, but it all happened really on Monday or Tuesday. And the way I was talking about it happening was on Monday and Tuesday, taking longer. I thought that they would weaken things a little bit further than they did on Monday, then try to rally them either late Monday or eventually after maybe a week start Tuesday. And then we'd see where that carried us to. But you can see that they did try to do that. It just happened in a way where the weakness was there on Monday morning. They kind of quickly got that out of the way, but they were not able to do much when they finally came in for the rally. I thought they might do a little bit more into Tuesday. This is your Monday right here. And so you did open and work your way down small, but that was it. They immediately came in for the market faster than I thought they would. And I don't think that helped them in a technical way because they ran into a lot of resistance. You can see there's the 50 SMA there in gold. There's the declining 10 SMA there in white that matched up with the 50. There's also another what was a resistance line at that point, which I'll make blue right there. You can see that now. So all that was there, and you had these declining shorter term SMAs. So I thought they would try to take a little bit longer, maybe through Tuesday, at least try to work this thing up and through back to the 20-day, but they couldn't do that. And I think what happened was Kashkari came out and he had his comments, I don't think were very good for equity bulls. And then in terms of the Fed minutes, which was probably their last hope, those were not really something that realistically could have been used to create a short squeeze. So that combined, I think, with the two factors we were talking about, to keep your eye on the TNX and keep your eye on the dollar DXY on Thinkorswim's platform, we were, I think in the right spot in terms of let's keep an eye on these for the week. And because of what we've been tracking here and in the sector situation video over the last, really, I think it goes back probably about a little bit further, maybe about a month or so. But we started noticing that this started acting better. And if you come and look at this with a little more data here, we can get it. I know that's kind of scrunched up on your screen, but we got pretty darn close to 43.33. I don't know what yesterday's high was, but let me see if I can get that for us. It got up to 43.28. So you were only 0.05 away. So that just gives you an idea. I still think they're going to try to push this through, but I think it became a little bit excessive in the short run. And that's maybe one reason why it's off today, right? But I still think there's more potential. My main projection is 44.28 for the TNX, that I think is the most likely place that it goes to. And I try to be conservative with my projections. And then if my more conservative projections are hit, then I just keep revising higher, right, in this case. But the dollar DXY also did its thing. And I think, so again, I think we were in the right place at the right time, watching the right stuff. And you can see that was very, well, you can't see it because it's got too crunched down. So this got up to that 200. We said this could be an issue. It's stopped there before, but if it does power above here, probably not good for equities. Same thing, of course, with TNX rocking and rolling, right? Probably not good for equities. So we will see, right, if they need to back this thing off and then try again, or if they just go straight through. I have a feeling it's going to be more of a back off first and then maybe an attempt later. But, I don't want to get too far into that. That's really not what I'm trying to really trade here. Anyway, we trade mainly the major index ETFs, if anything, that relates to the macro situation, more so than anything else. And of course, individual stocks are what we really focus on. But here's a look at the spiders. And I think what's worth noting, and I should have done this on the cues, and I know this is a little busy and I'm just having all kinds of trouble. I think I've maxed out Thinkorswim, and I need to basically come up with a reduced platform and just have a reduced workspace and for starters, and then I'm go from there. Just something that's absolutely just the minimum I need, not what I want. But here is the SPY, and you can see that really got almost to the penny, not quite, but almost to the penny. This thing got right to the 23.6 retracement level. So that goes from that October low we've talked about many times to that recent high. So that 23.6% of that move has been retraced, right? And that took from that high right to today's low, that took let's see, about 3+ weeks. So a decent drop. I can't rule out that it can't go further, but it did stop at a fib, and there was another flatline-ish type level nearby there as well. But my guess would be for next week is they try to, if we finish strongly, they try to maybe do a little bit more with it. Remember, they've got NVIDIA, and then I want to say like at the end of next week, they've got the Jackson Hole extravaganza, where these people that completely mishandle everything, probably intentionally, and make life very difficult for regular Americans, go and talk about how wonderful the job they're doing out in Jackson Hole, Wyoming. And that's their annual trek, basically. So, well, what can you do about it, right? Anyway, my thought would be there's a rally attempt, and given what's happening, I would think that rally attempt hits resistance at some point and just fails, and you see even more corrective activity. That's what I'm sticking with for now. It's the short-term path, right, that I think is a little more challenging at the moment. Do you get a rally that really surprises you, and they're able to move this back up a little bit more strongly than you thought, or not, right? Or not. It just keeps going. What I've said last week is that it's very hard these days, because I used to think that, you get to support levels and then you expect the bounce. Like if you get to a kind of a key level and you fall in, you got oversold. So in Rebel Pit, I barely have time to comment in there, but I did make a point today that just a little bit after the opening, with the way things were, right, the market on the SPY and the Qs, a lot of the stuff I look at was kind of bombed out in the short run in a significant way. And we just said, look, capture your profits, and you could always decide if you want to roll afterwards, right? Technically 2 different trades, but you're still in it, right? So it's sort of like a delayed roll, really. And then, or you could say, well, I'm just going to take what I could get for now, and then, I'll reevaluate and see if I want to maybe enter later, or maybe I'll wait until next week on Monday and decide, let's see what happens in the market on Monday, and maybe I'll decide to reinitiate another position to the downside or whatever. But I think things got, I think they got short-term overbought, and I think it was smart to do what we did just when we surveyed things. But that's my overall scenario. The short term is the tough one. How do we get there? Assuming I'm even right, which is never something I really do. But assuming I'm right, do you get to the 50? Does it get back up towards that sort of 444 level in the near term and struggle there? Does it even work through and get back up to a downsloping 20 that's rolling over? Maybe. So we'll have to wait and see. Remember, there's a gap back here that they left. So that's always interesting. There's plenty of gaps that were left on the way up, which makes the downside interesting. But the reality is that you did really get a risk off and that's not the right one. There is a great example of a 50-50 guess, and I blew my opportunity. I got it wrong as usual on the 50-50. But on this 50-50 guess, there was only one choice left, so I managed to get our sectors up. And you could just look across this board really quickly. And I'll talk about it a little bit more in sector situation, but just became risk off, right? Except for really energy, everything else really got hit down pretty hard and broke the trends we've been focusing on, right? Most of them broke the trends, and now they all have, at some point, earlier today, a lot of these daily RSI readings, aside from XLE, the energy space, a lot of the big sectors that hadn't really pulled back significantly, they all got towards 30, not there quite, but close on the daily early on today. The reading's different now, naturally, with the way they've rallied ever since. But as I said, on some of the other charting views, things were kind of bombed out. So he hit that fib that we saw. So I think that makes sense. That it all makes sense to me, at least, right? What they've done here today. In addition to that, you've got your expiration day type stuff where they try to muscle things to benefit themselves, right? If they don't want a certain level crack, they'll try to muscle it away from there. If they do want a certain level crack, they'll try to muscle it towards there, right? And if they can create max pin pressure at the heaviest strikes and that benefits them, they'll be only too happy to do that. So those are the two big ones. I mean, the Qs and the IWM. The Qs actually have retraced a little bit more, which is why, given how slow Thinkorswim is running, even after I just rebooted to kind of clear everything out, this is a little bit more. You can see that big dash red line there. That's the 23.6. So that is a little bit more of a correction in terms of that move from the lowest low since October to the highest high in the Qs. But about the same, and that's what we thought, like that maybe you'd get, at least for starters, this kind of a pullback, and it came about, right? I mean, we have to say that even if we're trying to keep everything even keeled, we have to say that this is what we've been thinking, and it all set up on the seasonality, the charts, the breadth, the development of higher yields and a stronger dollar. It all kind of came together. So here's the support line that I think is waiting for the market. You got really close to that, waiting for the Qs, and then beyond that's your 100-day. So there is support there. Like I said, I feel like there probably should be at least another session of attempting to rally. They've got the Jackson Hole, they've got the Nvidia and earnings later in the week, I think. And so you've got a lot of things they could try to that are big, kind of high profile, that they could try to use to ignite things. So never put it past them, right? Especially right when you get into the last week or two in August, where at times it can get thin, and these algos can probably then really wreak havoc if they want to. Excuse me. So while we're here, let's take a look at IWM, and we'll take a look at diamonds. And IWM really got rocked down. The good news for us, though, is we've had some spreads that we put in towards the end of July. We had some ideas and spreads, spread-based ideas, wide verticals to the downside in puts. And even in some other services like Phoenix, we had downside put butterflies too, and in the Qs. But we had IWM, SPY, and the Qs, and they've all fallen nicely. So those ideas, were there at the right time. So that was a really good case for us, where preparation really helped us out to kind of get ahead of the game and have those ideas ready to go to, because we did have a couple of updates since that original paper hit late in July that was a little bit longer dated. But the bigger ticket trades definitely happened in terms of the Qs, IWM, SPY for downside. We've had all those names, and it's been very good, but they were all bigger hits happened in later July rather than recently. But there's the IWM story right there. And as we said, right, we were wondering if this could really do it, because again, with rates moving up and smaller companies needing things to be not so aggressive on the rate front, and they don't have that type of a balance sheet, right, that your larger companies do that are, well, ones that are ran well. This type of situation, we were a little surprised, but again, you never know. So you've got to go with it while the trend is working in that direction. But like I said, that's had a really serious correction. And at today's low, that was below all the SMAs. As you can see, there's a gap down there for this thing to fill that we noted some time ago. So, I think there's more downside in there overall still. But again, do you get a day, two more, who knows, of rallying before there's another leg lower? I would say there's another leg lower coming. This is maybe just the first of two legs. We'll see. But in the overall grand scheme, let's take a look at the diamonds while we're here. I would feel the same way about everything. I just feel like, look, China's situation's rough. We've been talking about the situation in Europe with Germany, which is really the economic powerhouse there. That is not a good situation, right? Things are rough there. So I just don't know. Again, I say this on almost every week, and I put this on our little summary that we keep for the stream of consciousness discussion that we have, but I just don't see what's out there that's so wonderful. I think it's over there in Europe or the United States or China. Maybe Japan is I don't know, maybe Japan's doing well, but I mean, it's an outlier, and I'm not so sure that occupies the position it once did. So unfortunately, but there's your diamonds, and they're right on. You can see that I've got a flat line. I think that's pretty clear that you should see some kind of flat line support right about where we stopped, right? So that's not crazy what happened here. This is hung in there fairly well. I mean, you gotta say that you went from, I guess, 35,866 ish, something like that, near there, to we dropped down all the way to 30. If you do this in, I guess, Dow terms, 34,268. So that's a decent pullback of 1,500 points or whatnot. But I still think there's more to come. And like I said, this is hanging out maybe the best of them as the best of them for now. But I think if that whole risk off really resurfaces because these rates just keep going and TNX just keeps powering, finds a way to do that somehow, that's a problem. That's just a real problem. We already looked at those charts already, but you get the idea. So, the main traders for us are IWM's an excellent trader. I mean, I'd rather trade that than trade the diamonds. The spiders and Qs are also like something I prefer over the diamonds. In fact, we don't really see a lot of diamonds UOA to work with anyway. It's definitely not the most active major index ETF. So it is what it is. But yeah, so getting back to the main proxy for the market, you have to say, if you're sober about this, you say, look, there's been corrective activity. It's been pretty significant. It's not the end of the world. And now we have to see if bulls step in, try to save the month. If they do, how successful, will they be? Will they be successful enough to get to the 50 in gold, or even more successful, get to that light blue 20? What if they keep going and close the gap? That would be remarkable, but you just can't rule out that scenario either, because you just never know what these guys are capable of. Washington, it has become more and more over the decades, more and more interventionist. A lot of people were saying that they're running stealth liquidity program. It's running really at cross purposes to what the Fed's been trying to do, and that's one reason for the buoyancy. I've already talked about the statistical chicanery that's been going on. It's not just this administration. I'm not singling them out, but it's just they all try to put that spin. But it sounds like it might be getting even more egregious. But that might be the case with every successive administration. For all we know, I just don't have the data, the research to say anything specifically about that myself. But anyway, we were wondering, right, if there was a bear trap. And so let me just try to magnify things a little bit. We thought, could they be bear trapping these people right near the 50? And could they try to lift it back up and go? And they did try that on Monday. But that's all that it lasted. And I thought there might be, again, like at least one more day of that. So we kind of were right about the idea, but again, getting that path the right way exactly is really tough to say, in advance. So I think we were onto something there. Let's go through our stream of consciousness here that we would expect things to be the same, stay volatile. Probably the final week is no big deal. Jackson Hole earnings are out of the way and they kind of have a stasis in the market where there's no one's really buying or selling. You could have one of those listless conclusions. So if you want to sneak in some extra time off, again, without the knowledge of what macro news is on the way, that would be probably a good time to do it. It has been historically most of the time. We did note that once they lost that 20-day moving average in blue, we thought that the spiders and Qs then were destined to try to work their way to the gold 50. That definitely happened. We thought that was appropriate, and it did work out that way. Let's see. We thought the door was open to more corrective action. If we got what we got this break of the 50, so we did. So now we still think that's the case. This could last for a few months or even longer. Remember, if they finish the month poorly, that's probably going to seal our fate for September and maybe October to a great degree. That it might not be easy trading, right? Where they won't just simply take a nice pullback and turn it into a run right back to the all-time highs. You might be in more of a choppier sort of a day-to-day tougher phase. We're still staying at DEFCON 1 just because when you have these corrections, as I mentioned, that you can call the wiggles and waggles like we've been trying to a little bit, but ultimately a lot of these things have just persisted and swooned more quickly than I have expected them to in the last couple of years. And that, I think, maybe it's just a modern market. It just I feel like things are just keep happening a little bit faster than I expect them to a lot of the time, right? Just the way it's become. Let's see. What else do we have? I talked about this week's early sell-off. We talked about the DXY. The risk-off acceleration did come, right? We were saying that could be happening. We would maybe start to see that happen. It did, because you could see the market finally really got hit hard. But of course, the charts themselves in these sectors really show you that they've gone about and really sold nearly everything at this point, right? Not in some massive, crazy way, but they started to attack even the really strong sectors that heretofore hadn't given way and cracked. We did say that there was more upside in the charts over the last couple of weeks, but we said that it would possibly you would need to wait to see that get tapped, and that appears to be the case. I mean, so that was probably a decent hunch as well. Let's see. The big question now, right, could become if this weakness persists longer, the question could shift, and it may have already, but I just got worn out from Bloomberg this week, and I had to kind of get away from it just for like a little bit of quiet, because just the monotonous drone beat stuff it gets old after a while. But that's the thing. Like, if you have an ugly finish to this month, and this could bring about that question of, did we see an incredible, bear market rally, right, where you're in more of a longer term bear, and that's what we saw from October through July of this year? Or, right, is this really just, we're going to see a decent correction here, but then that's going to lead to another up leg? And the third year of the cycle, the fourth year of the presidential cycle that follows, being the two best years, that's what they call for. They call for the continuation of really bullish activity towards the latter part of this year. So think like maybe, I don't know, let's just say end of Nov, mid to end of Nov, and then you keep going for the first several months into the new year. So I think at this moment in time, that's far-fetched to me, but I wouldn't rule it out, just because overall, that third year of the presidential cycle that we reviewed so many times has served us well. I mean, it really has served us well. And so we can't complain about that. So I think that's the big question on the way. I think, as I said, the bulls do need to act quickly, or they're going to be under more pressure. And so that's what I would be looking out for in terms of them trying to somehow save the month to prevent a super ugly monthly candle. We did do the brief tabs check. Just a reminder, the gang does work their magic in accordance with all the calendars, economic, political, Fed calendar, earnings season, all that kind of stuff. News can be made to trump charts. And right, I'm still personally not seeing any wonderful catalysts in the short term to say, oh, sure, stocks should absolutely come roaring back. Look how wonderful this, that, or the other thing's doing. Maybe it's out there. I just don't see it. And what I have what they have tried to sell me, I haven't bought. I remember I'm looking at it. I'm thinking of all this car happy talk that was going on earlier this year, and I was just looking at it, saying this car market is going to get, as they say these days, wrecked. And in my opinion, and it still has a lot further to go. And I think the housing market's going to take it on the chin a lot more than it has to this point as well. We talked about Jackson Hole and NVIDIA. We talked about recently, right, how the dollar, TNX, VIX, all were worth keeping an eye on. I think they really proved that this week. They all made new recent highs this week. And right, that was all about like telling folks to get into the Phoenix portfolio for, among other things, trade ideas, sure, but really that big kind of volatility discussion and how you can position yourself in much more creative ways that a lot of people, when they get exposed to it, really like. They really like the stuff that we cover there. And we cover, of course, things we like to do personally. And I think those things tend to resonate with people as well, that when they see how we look at it. So we don't need to talk about the chicanery. We don't need to talk about the mirage that's been going on. We did see that things got risk offish this week with all those sectors getting hit. We still think there's more corrective action. And we still think there's a lot more room to fall if they want to, right? So I think my personal take is this is just the first leg. I don't know if you're going to crack the 200, right? I do think it's possible that we'd come to within proximity of the 200 on that maybe second leg lower. Now, if they end it there and start marching back up, then you kind of have your third, fourth year scenario back in place that we've talked about. If they don't, then it starts getting worrisome that this was maybe just pure fantasy and FOMO, chasing the tape type behavior. And I remember, I think for some people that watch these videos each week, I think a massive amount of capital was committed to the bull side, and that was like based upon it's over and there's another longer term bull market developing. And they may still be right, but if they're wrong, there's a lot of people that are really going to be wrong in terms of a lot of dollars wrong. And that could create really a rough situation going forward that could really be exacerbated, which again, I would get yourself into Phoenix, even if you just kick the tires for a week or two or a month, because you can bring those kind of questions up and then get some kind of a game plan together, at least in your mind. Again, we end up a week where we're coming out of oversoldness this morning that we talked about in Rebel Pit Live. And then we still think, right, that there's corrective activity on the way, more of it, I should say, and that main things to look at are still the TNX and DXY. So if they don't let this yield drop and this dollar just won't back off, and if they just find a way to continue to power higher, I think that's going to be what you should be watching to, because it really has borne out, and we've been talking about that for some time. That's what I would keep my eye on going forward for now. I still don't see many factors that are in place right now that support the equity market. I see a lot of things like there's a lot of contrarian stuff where people really did chase this, not just my assessment, but data that said how long everyone has gotten. This other other things are some of the automated stuff, where the automatic stuff, I should say, where people are, and CTAs, for example, and different players that switch things around to be long or short the market based on developments, and that could flip and bring about selling. From what I understand, if we go lower, the gamma situation isn't really a good situation as the gamma structure stands now. For bulls, it's pretty bad. So that's really it. Now the thing is that we still have that breadth has improved overall in terms of the bottom, like the market bottom, but it's really, as we saw, it's gotten hit pretty hard. So now it just becomes, right, for me, I'm pretty confident in saying that I think there's another leg lower coming, and the path is the tough call, which is always the case, right? So if I'm trying to do this video here today, what do I say? Is it okay, this is what's going to happen on Monday morning? It's very hard to make that call. You just don't know all the weekend news that will come out, what will trade in the markets that open before the US market, the Chinese market, the Japanese market, Australia, right, so on and so forth. And then you get to Europe and London situation, and then you work your way this way, of course. And so who knows what's going to happen. But I think probably, right, I can see them trying to work this thing back up a little bit more. And then you'd have to see, right, if it does start to roll over, is that because they start factoring in the NVIDIA earnings and commentary and the Jackson Hole, and then it just rolls over anyway? Or is it in front of that? If it's in front of that, then you've got to have that wild card, know that there's that wild card. And so it does make it tough to trade, because they could ignite a squeeze on those, using those as catalysts. So it could be a tough week for that reason. But I still think now, the way things are shaped up, bears definitely reasserted themselves. You got short-term oversold. There has been legitimate technical damage. It was overdue. It was overdue in a way, but it became on time according to our cycles and seasonality. So everything sort of made sense for a change, I think, to us, right? Where you can't say, why is the market still going up? Even that made sense in terms of that cycle I keep referring to. But now I think, right, you are at a time where if there's this minor sort of bounce and then another rollover, that could end the month ugly, right? Because by the time we get started here on Monday, it's 21st. You only have, right, about 9 trading days left, or 2 weeks really before the end of the month. And at that point, nearly 2 full weeks of trading anyway. But at that point, if things are ending ugly, like I said, you have an ugly candle. Now it's kind of strange, but when you have an ugly candle, usually you have a candle that tries to, shortly thereafter, that tries to address that in some way to the opposite side, which would obviously be up. But it usually doesn't mean that's the end of it, the very next month. It could, but it usually doesn't. So that's what I'm saying, that if we do end this ugly, it could be a few more months of tough stuff. And frankly, that's what that third year of the presidential cycle analog, or the seasonal data, cyclical data, whatever you want to call it, that is really what that argues for, that you've got both really developing over the next couple of months, a bounce back, a sell-off, another bounce back, another sell-off, and then an end of the year ramp. So that's what you typically see. And that could mean, right, that we stay in this, it's tough to call in a big way market. It's more like back and forth, back and forth, back and forth, trade it in both directions, get your singles and doubles, and get good little hits in there. And then if we do see more of a bigger trend break, or we see trend resumption, because this market really rights the ship and you start seeing the breadth improve and more sectors start to participate again, like we started to see, that could be big. But just drawing a line, right, let's just pick out this line here and kind of end on this in the SPY, right? This is really probably the most forgiving support line that I could draw, right about there, in terms of this whole big move from the ACK low all the way up. And you could turn that into a channel, obviously, with a resistance line above there. But this is probably one of the most forgiving lines that we could draw. In other words, it's not too aggressive where we're trying to find reasons to get shorted. And so this would kind of get clipped. It would be pierced, punctured, whatever you want to call it, violated. If you get below, at this point, it would be about the 150 SMA. And that's really where that's at 419 right now in the SPY. And so I wouldn't give up at that point, though. And the reason for that is that at that point, this is why this is hard right now. You still have the 200 down about 8 points from there. So it's pretty hard to say, yeah, it's over when the 200 hasn't even gotten rocked, right? That's still your daily equity prices are still above the 200-day, just because it's such a big line in the sand for so many. So you could say, well, then wait till the 200. Okay, well, that's a logical way to go. The only problem there is that the fib retracement at 403.78, that would give you a 50% retracement. And if you were able to start bouncing from there, that would still probably be considered bullish overall. So it's not that easy as it stands now. Maybe more action will develop and it'll take a little bit longer, and then we'll not have to face like, is it over or not for this so-called bull market in the near future. Maybe we'll have to hopefully face that question a little down the road. And like I said, even though I'm really more of an economic bear that's just trying to chart from moment to moment, week to week, to try to keep us on the right side of things as best we can in terms of our leans, I'm economically bearish, of course, but I have to say that I would love to be wrong. I would really love to be wrong about that. And all my concerns are overdone. I just can't get past that. They're not, though, at least not at this stage. So on that note, I'm going to wrap it up. I do hope that something I've shared with you helps you out this week or some week in the future. I'm going to move on quickly to sector situation, probably get that taken care of again, because I've got folks and family in town visiting, and I'd like to make sure that I don't miss out if some of my responsibilities as a host, etc., on Sunday would really gum up things for me in terms of trying to sneak a video in. So wanted to get it done today. I hope you've had a great week. I want everyone to have a great weekend, and just kind of keep sticking and moving. And even through like rough sailing trading, you should still come out ahead if you're not pressing your luck too much. Everyone take care, and thanks again for tuning in.